This one might shock you a little bit, or maybe it won't, but if you're a high income earner earning above $250,000, you will be subject to what's called Division 293 tax, which is an additional 15% tax on your concessional super contributions. In other words, it's basically taxing the rich. The way that this extra tax is calculated is once you lodge your tax return, the ATO will assess whether or not you are liable to pay this extra tax by issuing you with a Division 293 notice of assessment. To determine if you're above the $250,000 threshold, the ATO looks at your overall taxable income in your tax return. Then they add on your concessional super contributions, which can include employer contributions, personal super contributions, as well as salary sacrifice super. And then they also adjust for things like reportable fringe benefits, rental losses, investment losses, and so on. If all of these elements combined are above $250,000, then you will have to pay an extra 15% tax on the excess. Generally, when concessional super contributions are paid into your super fund, they are taxed at only 15%, which is why super funds are a very tax effective environment. But if you're subject to this Div 293 tax, then you're essentially being taxed again at 15%. When the ATO does issue you with the notice of assessment, they do give you the option to release the liability for this Div 293 tax from your super fund. It's one of the few situations where you can actually release money from your super fund before retirement, but also choose to pay it out of pocket. But don't be surprised if you receive one of these notices if you are a high income earner.